Welcome back on a bad day for those who were long the market. A really bad day for anybody who was long shares of Ebix. This is a software provider for the insurance industry. It had a deal to be acquired at $20 a share by an affiliate of Goldman Sachs, a private equity affiliate of Goldman Sachs. As I said, $20 a share. That deal, well, it is gone. In fact, it was revoked by both sides. No breakup fee paid. Why? Well, on June 14th, the U.S. Attorney for the Northern District of Georgia sent a letter to this company saying it's opened an investigation into allegations of intentional misconduct that had been brought to its attention from a pending shareholder class action lawsuit against the company. Now, the U.S. Attorney said the investigation is in its preliminary stages. Too early to make a determination of whether any violation of securities laws or other laws has occurred or whether any individual or entity will be considered a target, subject, or witness in the investigation. But that was enough for Goldman to say, see you later, and apparently enough for the company to say, we'll let you out of your breakup fee. Oh, that is ugly. Down 42% for that company. Of course, this was a small leverage buyout, but when we watch that move in high yield, we watch higher rates, watch those indexes, we also watch outflows from the high yield funds. You do have to keep in mind that we have a number of larger leverage buyouts that are, of course, dependent on cheap money to help make their economics work, whether it's BMC or, of course, Dell. Don't forget that a lot of this depends on financing in the high-yield markets. Now, they would seem to be fine right now, but it is certainly something as well to keep in mind. Watch those deals if we continue to watch these dislocations, and you have to assume a higher rate for what you're getting or perhaps having to place less debt than you might have anticipated. That can affect the economics and the returns of those deals overall.
David, I'm just curious because there are people saying this high yield correction could now last a couple of months, which means coming during a seasonally slower time anyway for banks. Does this actually ripple back through to their second quarter, maybe even going into their third quarter revenues?
It can. I mean, we saw Jefferies, which is a part of Leucadia, report fixed income, currency, and commodity revenues down 36%. Now, we don't anticipate that, but you're already starting to see that. That would be, of course, June has been even worse than the quarter that will be reported, right. At least for Jefferies it was. But yeah, it's a good point and something certainly to keep in mind. So we'll be watching that also.
Right. It's all up and down the food chain.